Good evening, everybody. This is Dennis Wilburn with the Active Trend Traders. I want to welcome you to this weekend's, and this is a Saturday rather than a Friday, but the How to Make Money Trading Stocks webinar. We're recording it this weekend because I'm on the road. I'm currently deep in the heart of Texas, speaking to you from Austin, Texas this evening, but I wanted to share some information with you about what's going on in the market. Of course, Mike Traeger, I'll be with him tomorrow up in Dallas. We're going to be talking about some strategies that we're going to be working on for the active trend trading system through the end of the year. And unfortunately, it is real late over in Austria, where Michael Bischoff currently resides. So let's get going here. I want to remind everybody that all the materials that are presented in this session are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. There's Michael's disclaimer. And so I want to remind everybody that this week's training topic for the active trend trading members will be recorded. It will be broadcast out on the 31st, which I believe is Wednesday. Still on the road. We'll be on the road for about another 7 to 8 days, and then we'll be back in California and get back to a normal schedule at that time. The promised recording of the Fixing Bad Trades will be out at that time. I hope if you are an active trend trader, you have had time to look at the seasonality video and training session that we did last Wednesday night. I think that it was can be a real eye-opener for everyone to take a look at that. Again, training is one of my primary objectives for all of our active trend traders. So how's the market doing? Well, as of the close yesterday, we saw basically this past week all we got was a bunch of churning and indecisions. We had the GDP report out on Friday, and GDP is continuing to be retarded, and I don't mean that in a bad way. It just basically it is not, our GDP is just not growing the way it has in past recoveries. And then, of course, our favorite Fed head spoke on Friday from Jackson Hole, where they had a big financial symposium every year. And what did she say? Apparently, Yellen and Fisher got together, had played a little bit of good cop, bad cop, one saying how bad things are, the other one saying how good things are, to expect the Fed potentially to raise rates coming this September. So if you're looking at doing any type of refi for your home or anything like that, you may want to do that. What will a bump in interest rates do? They'll probably only go up like 1/4 point, the same as they did last time. Well, what will that do? Last time they bumped it up a little bit. The Russell reacted poorly to that, and the market actually reacted poorly to that also. But the drop was very short-lived, much like the Brexit. You had kind of a one-day really big, huge sell-off, and then kind of a flash crash, and then right back up into the upward mode. All the indexes are coming off, making new highs, and so we're looking at potential pullbacks. Consumer sentiment also slipped for the month, and has continued to be slipping. And that folks, are they beginning to get a hint that maybe things in the economy aren't as great as what the folks in the government would have us believe? But at the same time, the U.S. stock market is still the only game in town. So we have a lot of international funds and international investors pouring money into the U.S. markets, along with the central banks overseas doing the same type of thing. So where to from here? Great question. I wish Mike was on the this evening, because I know he would have some very colorful words to say about what he thinks Yellen and Fisher are up to, but he's not. So maybe I should have recorded him also and just got a little bit of a broad blast of what was going on in Mike's thought process. Here's where we were last week with regarding the percentage of stocks above their 20-day moving average, and also the spiders, which is our emulation of the S&P. We were just basically tracking along, moving sideways. Same thing for the percentage of stocks above their 20-day moving average on the NYSE. Now, this week I changed out, as you can see, I changed out the indicators and brought back the candlesticks for the percentage of stocks above their 20-day moving average. But I wanted to see the movement actual from high to low for the day on the spiders to give us an idea, and I think it gives us a much better picture of painting in these levels of of support and resistance on that and the range of that. The S&P has been stuck in about just a little bit over a percentage range up here, 1 percentage point range. Down here it was about 1 percentage range too, but it drove along in this sideways movement for about 14 days before it gave a head fake to the downside and then bounced back up to a higher range to bounce across. When we do look at the S&P chart, you'll see what could potentially be a little bit of a, let me get rid of that, go back to the curve line, a little bit of a left shoulder, head. We don't know what's going to happen over here. We do know that the Fed is probably still quite interested in keeping the stock markets settled and not reactive. And one of the things that really surprised me about what Janet Yellen did have to say, that she did say that the Fed was ready to take action in buying bonds and putting the money into the U.S. economy that way, which basically means they're going to be printing more money and increasing the national debt at some point. That cannot go on forever. However, the markets right now, when we get to the market chart, you'll see, they're still in an uptrend, but are showing, a little bit of signs of weakness. One of the things that I really found interesting was that we had a very wide-ranging range on the percentage of stocks above their 20-day moving average, all the way down here, just slightly below 50, all the way up to 65 for the week, or on Friday. And Friday's candle on S&P, or on the spiders, was also a very large range candle and basically engulfed all of last week's and several weeks worth of price action. I've done the same thing on the percentage of stocks above their 200-day moving average to get a flavor for what's going on there. We've talked about in the past how this resistance line there was showing that there was still some potential weakness going on here, where although we have pushed up to higher highs with the S&P, the percentage of stocks above their 200-day moving average has not. And so it's still sitting at a pretty healthy level. About 70% of the stocks are above their 200-day moving average, but it's like they're stuck in a range between the 200 up to the 20, and the 50-day moving average is in there somewhere. So what's this telling us? Basically not telling us a lot per se, especially on a monthly basis, but we will get a new month starting on, I believe it is Thursday of this week, when the 1st of September starts. Will the 1st of September, the last week in August, and going into September, will it carry on its bias towards having a negative September, which we saw last week from the training we did on the on seasonality, that typically August into September into the early part of October, first, second week of October, are typically kind of down periods for the market. Now, in one way, we could look at that as being very positive because we've been looking for a healthy pullback to kind of shake things up, cool things down for a potential then turnaround first or probably around the second week in October for a nice little rally up into the election. And then after the election this year, I don't know if the past bias of the October, November / December rallies that tend to show up every year, if that's going to take place. Some of the questions I'm asking is, will the winner of the election dictate which way the market's going to go? And we'll just have to, wait and see. If Hillary wins, will the market continue to rally because everybody's happy with that? And the Fed has worked really hard to make sure that the party that is in power, and as we saw in a study Mike did, about 80% of the time, if the market is up, the party that is in, that has the presidency tends to win again. And if they don't, and Trump does become president, will the market then basically fall out of bed, and all this weight and inertia that we've seen building in other areas of the economy, will those finally weigh down on the market and we go into a more significant correction? Should be interesting to, like I said, I'm not calling it either way, but it should be interesting to watch that play out. Our objective is to, one, we're in a nice uptrend. We're waiting for a nice pullback so we can get going to the long side, and we'll just continue to wait for that to happen. Okay, before we go to the charts, let's just take a look at where the Dow is compared to last week. And basically, it dropped a little bit from last week, from where it was last week. Actually lost about 1%. 0.6% on the S&P. The NASDAQ also about 0.6%, and same for the about 0.4% on the NASDAQ composite. Interesting enough, the Russell, which has finally gotten into gear a little bit, had actually got up to 8.99% and is actually up since we had our session last week. So let's take a look at the indexes to see what they're telling us. Okay, here's both the daily and the and weekly charts of the S&P. Let's start over here on the weeklies. Weekly TSI has finally rolled over and is just about to break. We're putting in as we spoke about last week, we already had some good negative divergence going on in the momentum. And so will this continue through to break down to, come down here and test the, 2150 or even the old breakout level of 2134 and then rebound? Or will we get what could be the potential of let's throw in a fib retracement on there. Let's just take a fib from the low back on the 27th of June and draw that in there to the high from last week. And take a look at that because this is a really good swing low, swing high. So where might it go? If it does duck all the way back into the fib box, then that would put it down somewhere between 2125, 2117 here, down to 2069. And so a healthy retreat back into that level would in reality be a very, would be a very good situation if it happens between now and the end of September to just kind of peel back and then anticipate a potential bounce off of that. we can use the, here's the 40-week moving average, which equates to approximately the 200-day moving average. As you can see, it's just above the 618 retracement. And if we throw on another one of these, what happened last time we had one of these moves? And if we can take this move either from here up to here, and as you can see, it got back right back to just past the 23.6 retracement, and then later on it got down to the 32 or 38, and then we take a look there to this other high here. I got down to about the 38.2 and then bounced from there, and which coincided with, of course, the rebound off of the, and this is the Brexit. This is the Brexit flash crash that we had late in June. On a daily chart, this huge move, basically from outside move from the high here, this is all Friday, it ran up and rallied up initially on some of the news for the day, and Janet Yellen was speaking, and then all of a sudden it reversed and closed down. Note, it closed in the bottom half of the candlestick. It closed below, again, below the 20-day, and we've got the 8-day kind of peeling down now, so both the shorter term moving averages have been hammered down. So the next logical level of support once those are broken is where? Well, it's down here at the 50. And what does that correspond to? Well, 50 is sitting here, and we've got this low here, draw that across. And that corresponds to about where the 50 is, about the 2150 level. What are our other indicators? The true strength indicator has dropped below the zero line, which typically means that we're going into a downtrend, even if it's short-lived, and then the momentum on a weekly basis had just been moving sideways, had not really done anything as this spiked up to make a new high, moving sideways, and it too broke a little bit below the zero line, and whenever it's down below the zero line, that tends to mean we're going to continue, have more selling in the very near future. So that's the S&P. Let's take a look at the NASDAQ. Okay, NASDAQ was looking a little bit more healthy than, let me get rid of this. The NASDAQ was looking a little bit healthier than the S&P. However, it too is starting to put in its topping pattern and looks to be kind of a slow rollover, and those oftentimes can be quite powerful to the downside. Also, if you look over here on the weekly chart, the TSI has not rolled over as much, and also we did not have negative divergence on the momentum indicator compared to its last high, unlike the S&P. Does it mean anything? But we are having, this is our first 2 weeks worth of red candles, even though those spinning tops that we've had in the last 1, 2, 3, 4, 5, 6, 7 weeks, and then we followed with 2 short weeks down. It is hanging right up here about the 20-day moving average. Did not close below it, but it did break below it. So that may be showing a little bit of kink in the armor there. Russell? Okay, Russell. On Wednesday of last week, the Russell put in a bearish engulfing pattern of a move, a strong move up, and then basically has followed that up with a retest up here at the past high at the 1250 level, and a slight close below the 8-day moving average here, and so it's still tracking in a more healthy way than the S&P, but it did push its way up into the resistance zone that runs from 1250 all the way up just short of the 1300 level, and so we'll see if it pulls over and rolls over from here. Where might it go? It's also at the top of the Keltner channel. You can slide all the way back down to the bottom of the Keltner channel, down to the 50. If we throw on a fib on this particular one, there's a lot of ways. You got kind of a swing low here, but if we take the let me get rid of that. Let's take this swing low here, from here up to all the way up to its past high up here. And as we see, if it retraces even back to the 23.6, it puts us back in this area of resistance. So we have a resistance zone that runs anywhere from 1220 all the way down to the 1200 level. So that would be a place where we could look for potential reversals and turnarounds to go back up. But market could surprise us going into next week. But we'll see if the, as I said, we'll see if the tendency of having a slow, a September sell-off, we'll see if that, comes to fruition in the very near future. And remind me to talk just real briefly about the setups that might be happening in the index ETFs. That's SQQQ and SPXU, I believe, and TZA may also provide some opportunities. Okay, so path of least resistance, at least for the interim, I think that the evidence is starting to pile up, the clues are starting to pile up, that short-term stronger pullback that could transition into more of a sideways move. Now, for a longer term, we're still in an uptrend. Even though we do have the negative divergences now, so a downside trade would not be out of the question. So, but until that uptrend is totally busted, of course, this is the ultimate. Now, I know when Mike looks at this, long term, he thinks that we're heading for a significant downturn, but we don't know from what level at this point. We don't know how high the market's going to push from here. It may have topped out, but that we're looking at a more significant downturn. So this week we had a pretty good week with the strategy 3. Strategy 2 more or less stayed the same. Had a nice bit, was able to pull in the trade on plant PNLT, which is Planet Fitness, and was able to pull that in to bring our strategy 1 back more into line. So I'm pleased with that. Through the end of the year, okay, if September is a weak month, we don't want to be looking at portfolio building as much during this time frame unless it's to the downside. But let's say we do get the strength that comes back into the market in October, we'll look at some really good opportunities for portfolio building going into the end of the year. And so that's where I'm looking at this, basically this number, pulling more into line and getting back on the positive side going in from October on. If we can add a little bit to that, some shorter term swing trades during September, that will be very beneficial. Here's where we are on the equity curve, and this past week really helped us push this back up. We're about $2,400 away from connecting up with the 40% line, which reflects that's, if we follow the upper line all the way up, that's a 40% gain for the year, which is our target. Again, I'm saying I'm very thankful for the strategy 3, strategy 2 trades, and so overall, bringing the strategy 1 trade back into line with the other strategies. So pleased with that. Okay, on the Strategy 3 trade, we'll talk about that really briefly. The first half of the Tesla trade, which is basically just a long leap and long call, one each, that we opened back in September of last year. Again, remember our objective is to both pay for the position, which is $9,100, or correction, $9,010. That's our capital invested. That has already been done. We have paid for that, and now we're adding to that. And we have gained $8,276 so far in the year that this trade has been open. As soon as this number here hits 100%, that will mean that we have not only paid the $9,010, but also gained another $9,010. This position will then be closed, and we'll move on to a potential. If Tesla still looks like a viable candidate, we'll just basically run out and purchase the 2018 leaps and just continue on with the same process. So here's one of the Strategy 1 trades I was talking about with PLNT. It actually closed itself out this week also. We had jumped into sort of a pre-earnings run. At earnings, it jumped up and hit our first target, which equated to actually overshot our first target, so we got out a little bit more than what we expected. It was supposed to be a 5% gain. We got it with a 6.32% gain. And then on 823, which is this candle right here, shot back up, hit actually this is the moving average envelope, hit that, and I think we had a stop in there at $23.28. It hit that and actually sold out at $23.30 for a little bit more than a 15% gain. So overall, from 8.2 through 8.23, about a 10.6% gain on this particular trade. We've chatted about the gold seasonality trade that we did a few weeks ago. We actually jumped out of that, the full position at the beginning of August. And one of the things we learned with our seasonality training on Wednesday night, gold can continue to roll forward into the latter part of September, October standpoint. So maybe looking for a potential, second bite of the apple with a gold trade going into the end of the year. Just stand by for the alerts on that one. So future presentations. The monthly BAM meeting in San Jose will be in September. It will be the second Saturday in September. We're not going to do it on Labor Day weekend Saturday at the Masonic. And I'll be presenting about staying on the right side of the trend. And then this past week's training, seasonality, does it work? Again, if you have not seen this video, please take a look at it if you're a premium member. And so then there's some of the things that I am working on. I'll be working on those when I get back to California with our son, daughter-in-law, and grandchildren. So I just want to remind everybody that Active Trend Trading System, our motto is to both clarify, simplify, and multiply. I know Mike and I are, we work on trying to keep things simple. I want to get to the place where, and I think having the knowledge about seasonality and options, where we can actually trade fewer times but have a higher probability of success. And so that's what our objectives are, because I know that so many people are working full-time. You don't have time to watch the market all the time and basically manage trades. And so if we can identify some specific times of the year when it's best to be in the market in different types of either stocks or ETFs, that's what we're after. So the Active Trend Trading System is based on the 5 pillars of active trend trading. We identify what to trade, when to enter, when to exit, what strategy we're going to use, and what to expect. I know too many people who they basically jump to strategies before they have a system in place. The active trend trading system is a simple to follow system. And then we have attached 3 basic strategies. Portfolio building with stocks and options, or stops and index and ETFs. Basic options, we allocate 10% of our trading capital to this, and then wealth and income building, which is where we sell premium, we sell options to gain the premium each week. And we have a little over 20% of our trading capital allocated here. And these 2 for this year have worked out very well. The stock and the portfolio building is coming along. I'll just leave this up for a second. This is what the early warning and the active trend trading members do get with regard to pre-trade notification, text messages, weekly training, access to the website. And a gentleman at our last band meeting said that I need to look at starting to do Twitters. Now, I don't know how many of you Twitter out there, or tweet, or whatever it's called, but he says that there are ways I can set up a Twitter account where it will only go to members for the actual trades, but then we can communicate to a much wider field of folks out there on more general market things. So I'm looking into that and how to do that next time. So if you remember last week, I was talking about I love to poke the bear, and as you can see, maybe my poking the bear when we were in Springfield, Missouri last week led to this little downturn this week. But you have to remember where I am today. I'm also back in Austin, Texas. So you're going to either be poking the bear or riding the bull. And since I'm an old Texas Longhorn alum, wanted to make sure I got that picture of what a beautiful bull that is with those Texas bluebonnets. Anyway, we're having a lot of fun out here on the road, and I hope that you're able to trade along with us. So that's all I have for tonight, folks. I'll see you next week. Well, actually, I'll do another recording next week, and then I'll be back live on Friday after Labor Day. So I wanted to, before I move on, or before we totally close down, I wanted to show you a couple of stocks that I am looking at for going into next week. And then we will call it a night. Okay, one of them is basically Tesla. You know I like to trade Tesla. Tesla has been going through a little bit of weird stuff lately. And when I say weird, it did some things out of the ordinary. When it had earnings back here, in the past, earnings for the last 2 or 3 years, on the week of earnings, the implied volatility would tend to jump to at least 150 to 200%. This earnings period, it just barely got up to a 100%. Therefore, I'm going, okay, what's going on? What's going on with Elon Musk and the acquisition of SolarCity? Is that going to hurt Tesla in the long run? We broke, at least we came down really close to an important level. The $220 level was an important level of support. But as you can see, there's a secondary level of support down here, about 218.50. And of course, you got the 200-day moving average sitting right below that at 217. And so is Tesla basically just pulling back? Low volume, not a lot of trading going on. Is it just, it's in one of those situations where we've got a we've got a little bit of a triangle thing going on here. And so is it going to step off this ledge and fall? Because if it steps off this ledge and falls, you've got some support down here at 206. but then the rest of it's all the way down to 190. That's a $20, no. Yeah, that's a $30 drop from here to here. That would be a good trade to the downside. Or is it going to bounce back up, break through this resistance, and be on its way back up to about the 235 level? Regardless of which it does, Tesla is a very interesting stock to keep your eye on. Again, it may be weakening, and if it does weaken, it tends to, you talk about seasonality, it also tends to show weakening into the end of the year, and then reverses off of that and then goes into the new year. So that's one. Let me get rid of those drawings. Okay, one that I'm looking at for the potential to the upside is WAR. That's Worthington Industries, I believe. And what's it showing us? It basically, it's holding the 50-day moving average nicely. It got a couple of bounces off that, but as you can see on lower volume, but I'm just waiting to see, okay, is it going to basically bounce and go up? Is this a flag that it's putting in right here? And then it's going to rebound and move up off of that. But I'm looking at, anywhere from where, this 4250 level down to the 50-day moving average, which is down at 4240 as a potential entry point. But if it drops after that, drops this, I think, let me move this. There we go. If it drops this level here, which is a swing low, which is down at 4167, I would put a stop just directly below that at 4150. And if it blew through that, if I was in close to the 50 and it broke and blew through that, would be a very low risk trading opportunity. The other one I'll cover real quick. Am I typing that in right? Our good old buddy Netflix. Which way is it going to go is basically the question on Netflix. We've got a very nice, let me draw this in real quick. It's got this really nice wedge, whoops, it's got this really nice wedge going on here, from here, and from here, coming up there. And so it's wedging its way across, and it's going to break one way or the other pretty soon. Again, this push-up right here was done on very low volume, could be time of year, but Netflix production-wise had run into some issues. It's a stock that's, of course, not going away, but at the same time, it does show some really nice movement. But we're away from earnings, which it fell out of bed with earnings, and so is this just a little bear flag back up to the top of the trend line? So watch for that for a potential drop back down to the downside. Again, could go either way on that, but it is one of the things with a stock. Once a stock gets below 100, it tends to then roll over and stay below 100. When it bounces above 100, well, then that improves the likelihood that it's going to at least go up to 110. And if it closes and stays above 110, that increases the probability of it going to 120. But at this particular time, it is living below the $100 level. Let me get two more stocks and then we'll be done here. SPXU. This is the inverse 3 times leveraged index ETF for the S&P. Remember, it goes the opposite way of the S&P. Looking at this, very nice positive divergence here on the momentum, and on this particular case, the true strength indicator is bottoming and starting to move up. It is looking stronger, and as you can see, more volume coming in here as it's breaking back up. Where might it go? You know, that's a great question. If it went up from here, like if it went back up to the 50-day moving average where it's at right now, that would be a 4% gain. If it went back up to the moving average envelope, that would put it up about a 10% gain. And if it made it up all the way back to this past resistance at 26, that would put it about 11% gain. So that's one that I'm keeping my eye on going into this week. Wouldn't want to, you know, wouldn't want to enter a lot of this, but let me see if I get it. I wouldn't want to enter a lot of it. I want SQQQ. But it may be worth picking up a few shares and just see where it goes from there. Same thing for this is the inverse of the Qs. Again, opposite indicator of what's happened with the Qs. And it looks like it is bottoming here at 14, so it's at 14.30. If this one ran all the way back up to the 50, well, that'd be about a 10% gain. Ran all the way back to 16, you're looking at about 11%. These inverse index ETF tend to move quickly, and so it's like if you are in them, again, just a partial position, and then just appreciate the ride. When you hit your 10, 15, and sometimes even 20%, the move back here early in May. Well, when it topped out, it hit up here about 23%. Now, we won't try to get all of that move, but if you can pick out, you know, 10 to 15% in the middle, it's a really good way to supplement what's going on, especially with the early warning alerts. And I'll just do TZA really quick. Same thing with TZA, it's sitting down here about 28. The swing low is at about 27.46. And it may be setting us up for a potential run back up. And if this one ran back up to resistance at the 32 level, that would be a nice move of about, just about 12%. So with that, folks, I'm going to call it an evening. Thanks for joining us and checking out this video. We'll be chatting with you again next week, and if you're a premium member, an early warning alert member, just keep your eye peeled for those text alerts and email alerts. Good night, everybody. God bless.